Good afternoon and welcome to this week's webinar. My name is Lorenzo Pederzani and I'm here with Joe Bask and Matthew Evans, my colleagues. On today's weekly webinar, we are going to go over what I think is the most important risk that needs to be managed with anybody's retirement, which is sequence risk, which is effectively the risk of retiring at the bad period of time in the stock markets. A quick disclaimer before we get going today: anything you hear today from Matt, Joe, or I are our opinions and don't represent the opinions of Hollis or Industrial Alliance. So getting things going here today, Matt, if luck isn't on our side, how do we protect ourselves from an unsuccessful retirement? And how does that dovetail in with our investment philosophy?
So our tagline is boring is better, and what we're going to explain today is why we think a boring approach does yield better results in retirement. So our investment philosophy is three parts. The first is ensuring that our investments pay us a nice, healthy income. The second is putting together investments that will create a lower volatility portfolio that will fluctuate less. And finally, keeping costs reasonable, because higher costs do eat into returns. So when we're looking at volatility, let's look at the math. If your portfolio were to lose 5%, it needs 5.3% to get back to where it started. As you work your way along this line to the right, you can see if you lose 50%, you need 100% to get back to where you started. So it's obvious the less you lose, the easier it is to recover. So Joe, why don't you explain what sequence risk is?
Sure. So I think it's important to point out that sequence risk is a new risk that emerges when you begin to withdraw from your portfolio. And it's the risk that losses in the early part of retirement can very adversely affect how long your money is going to last. And so to really drive that point home, we're going to look at an example, the tale of two investors. So we have a lucky and an unlucky investor. Your eye may be drawn to the return rate. It's the same 6.7% for both of these investors. However, the order in which they get their returns is different. So for our lucky investor, you can see that in the early years, there are some really strong positive years, followed by 2 negative years at the end of this sequence. For our unlucky investor, again, it's the exact same set of numbers, but we reverse the order. So the unlucky investor has 2 bad years in early retirement, followed by some good years towards the end. And if we remember from grade school multiplication, 3 times 5 also equals 5 times 3. The answer is 15 in both cases. So here, different orders, but they have the exact same return rate. Now let's first look at an example where they're not withdrawing. So you'll see that both of these investors start off with $1 million, and they're both going to end up in the same place with roughly $1.79 million. What you'll notice is that they do take different paths to get there, but they're going to end up at the same place. So the conclusion here is that when there are no withdrawals, there is no sequence risk. However, as soon as we add withdrawals into this scenario, so in this case, both of these investors are going to be taking $75,000 a year from the portfolio. All of a sudden, you can see sequence risk rearing its ugly head. Our lucky investor ends off roughly where they were, a little over $1 million in capital, whereas our unlucky investor has 32% less capital than the lucky investor. And really, that can be attributed to those 2 bad years in early retirement that just really eat into that capital. So let's just look at the first 2 years to really drive the point home, because that's where the damage is done for the unlucky investor. So our lucky investor, you can see after 2 years, that big year in year 2 really funds the withdrawals, and you can see the lucky investor has almost the same capital as they started off with. Our unlucky investor, you can see those 2 negative years really compounding against the investor, plus the withdrawals. After 2 years, that investor is down almost 40%. So this is a very real risk. And again, sequence is a problem that's created when you have to sell your investments when they're down in value. So moving on, we're going to now focus on the strategies that we implement, starting with our cash wedge strategy. So Matt, can you tell us a little bit about our cash wedge strategy and what that is?
So as Joe mentioned, really sequence risk comes about when you're selling a falling asset. So we'll illustrate what a cash wedge is with an example. We have a retiree with $1 million portfolio and they need $40,000 per year in retirement income. They're going to be invested in our Westmount retirement income model, which is a collection of bonds, stocks, and private investments. As they approach retirement, we are going to carve out $60,000 into a high interest savings account. Please note this is 1.5 times their $40,000 need. The remaining $940,000 remains invested in the portfolio that pays an income of about $33,000 a year. We are going to use this high interest savings account to fund their retirement, therefore avoiding selling those falling assets. So let's look at an example. As you can see here, that $60,000 initial cash wedge that we built can last them from 3 to 5 years without having to sell any assets. So when markets are down, we do not need to go to the portfolio to fund retirement. Instead, we're going to use the cash wedge to fund retirement income. And then when markets are up, we're going to trim profits from the portfolio and rebuild that cash wedge back up to 1.5 times the need. So the second strategy that we utilize is a lower volatility portfolio. So Joe, can you tell us why that works in retirement?
Sure. So again, I think using a case example will really make this easier to analyze. So we're going to look at Mr. Buffett and Mr. Cautious. Mr. Buffett, a more aggressive investor. Mr. Cautious, a lot more conservative. You can see they both have $1 million as their starting point. They're both going to withdraw $55,000 per year. Mr. Buffett's going to have a higher compounded annual return rate of 4.7 versus Mr. Cautious at 4.1%. Below that is standard deviation. So that's a measure of how much the portfolio is fluctuating. You can see Mr. Buffett's portfolio is 19% versus Mr. Cautious at only 3.4%. So Mr. Cautious's portfolio is fluctuating only 1/6 as much as Mr. Buffett's. Now, the interesting conclusion here is if you follow the return set, after 10 years, you can see that although Mr. Buffett does have the higher return rate, he ends up with less money than Mr. Cautious. So again, let's just look at this graph over time, and you can see Mr. Cautious in the green, his portfolio value is fluctuating a lot less. Mr. Buffett, you can see the wild swing there in early withdrawal period. So the end result here is that Mr. Cautious, although he or she has a lower return rate, because of the low volatility, ends up in a better position than the higher return rate portfolio. So while returns obviously matter for retirement, it becomes a lot less important, or it takes a back seat to volatility when it comes to retirement. And a lower return portfolio can outperform a higher rate of return portfolio in retirement. So next, we're going to look at our last strategy, which is keeping withdrawal rates reasonable. You've probably heard us talk about this as sustainable withdrawal rates. So Matt, can you tell us about that and some of the research behind that?
Yeah, one of the most important pieces of research on sustainable withdrawal rates is the Trinity study, which really takes a look at retirement success, which is defined as not outliving your money. And they look at 3 important factors: how long you plan to withdraw from your portfolio, how much you need from your portfolio or your sustainable withdrawal rate, and finally, how is your portfolio invested, the asset allocation. So let's look at the first example, 100% stock portfolio with a withdrawal rate of 4%. So an example of a 4% withdrawal rate is $1 million portfolio with $40,000 being withdrawn every year. So as you can see at that 4% withdrawal rate from 15 years, that is going to have 100% probability of success. As you work your way down to 30 years, 94% of the time it will be successful. If we introduce bonds to the portfolio and create that lower volatility scenario Joe spoke about, you can see at that same 4% withdrawal rate, we have 100% probability of success across all time periods. Taking it one step further, if we have 0% exposure to the stock market or 100% GIC or 100% bond portfolio, you can see that same successful scenario with the 50% stock, 50% bond, no longer is the case here. So you can see getting into 20 years, you're already at 95% success, and moving out at 30 years, you're only successful 44% of the time.
So Matt, I just want to say too that in a lot of cases, the planning we're doing, we're looking at the examples we're using are clients who are in early retirement, but the same can apply to someone who perhaps does not have as long of a retirement income period. So if you took someone who was 80 and we were doing planning to age 95, that just means that we can actually safely increase their withdrawal rate, given that the time frame is not as long. So I think that's really important as well.
Great. Well, thanks, Matt. Thanks, Joe. A very quick summary here. What we've talked about today is sequence risk, also known as sequence of return risk, which is essentially how do we deal with managing being lucky or unlucky at the beginning of retirement. The three things, obviously, is building a cash wedge to ensure that we have many years where we don't have to touch the portfolio if we end up being unlucky and retire at the beginning of a down market. Making sure that we have portfolios that are built with kind of a low volatility philosophy in mind to minimize fluctuations and minimize the chances of sequence of return risk. And also making sure that we are always adjusting the sustainable withdrawal rate for clients, as they go through retirement, to make sure that we're giving them the most amount of money possible for their age.
Thanks, Lorenzo. Thanks, Matt. We want to thank everyone for tuning in. Hope you enjoyed this presentation, and we look forward to seeing you on our next week's live webinar. Thank you.